Morning students, welcome back to the session on audit. So today we plan to continue with our series of auditing standards, and in the last session we took up SA 450 that was about misstatements which the auditor needs to consider during the course of his audit. So we'll continue on this, and we discussed about the meaning of misstatement, which can be categorized into two parts. So we can say misstatements could be the errors, means the mistakes which are unintentional, or the misstatements could be because of the intentions of the management or maybe of the employees of the company that becomes a sort of fraud. Now, either of these situations may lead to errors which may impact the financial statements. Plus, we also considered another aspect, and that was around materiality. Because even though there could be errors in the financial statements, auditor may not really be bothered about them till the time the misstatements are not crossing the materiality threshold. And that's why this determination of materiality and this assessment of misstatements which are identified along with the materiality threshold is something which requires evaluation by the auditor, and it's purely judgmental. We discussed that there are certain benchmarks using which materiality is determined, and we are not getting into too much details around the materiality. Our focus was really on the assessment of the misstatements and how should the auditor really deal with those misstatements. So let's move further now, and we'll try to now look at those situations when the misstatements are identified and how the auditor would be taking care of all of those misstatements. So now in relation to misstatements, we categorize the misstatements further on the basis of the materiality which is involved. So I'll just again put down those misstatements in two parts. One that is crossing the materiality threshold, and the other one which is within the tolerable limits. So we are saying above materiality and the one which is below materiality. In relation to categorization of the misstatements in terms of above materiality or below materiality, we also understood that when it comes to misstatements, we need to check the misstatements on an accumulated basis. Means we need to just make sure that all the misstatements which are affecting a particular head of the financial statements on a cumulative basis, then even though individual misstatement, individual error could be less than materiality, but if the total of all the errors related to that particular head, related to that particular line item, crosses the materiality threshold, then that will be covered under this category and not under this category, right? Now, as regards the errors or the misstatements which cross the materiality threshold, we discussed that in this situation, management has got only two choices. One, to correct those misstatements, correct them in the financial statements, means pass the adjustment entry so that these misstatements go off and these are rectified in the financial statement. This is the first option available. Or auditor will not have any choice but to report that. Report in the auditor's report. So that means reporting implications will arise. And that's why I would say this part is quite easy to understand. The moment the materiality crosses the threshold, then the auditor will have to assess the reporting implication. Now, the reporting implications could be dependent again on various factors. which we'll discuss when we'll be talking about the audit reports under various types. This could be a qualification, or this could be an adverse opinion, or this could be something which is in the nature of at times disclaimer also, if some of the information is missing around the misstatement. Now, as regards the misstatements which are below materiality, but which cross a particular threshold. Now, what is that threshold? That threshold is known by different names. Some practitioners call them as de minimis. Some practitioners call them as trivial threshold, or this clearly trivial threshold. So you can just say that in terms of materiality, basically materiality can be categorized into three parts. Okay, let's suppose this entire chunk is the materiality. In this materiality, this particular part, okay, or maybe say this particular amount is called as trivial threshold or clearly trivial threshold, which is very commonly called as CTT. So you can say it's a very small amount below which, if there are any errors, then those may be ignored. Okay, these are like, say for example, a company having a turnover of approximately 50 crores and having a profit of say approximately 1 or 2 crores. And if that is getting audited, then any item or any of the errors which are in the range of say 500 or 1000 rupees only may be ignored. Because even if we look at all of these errors on an individual basis, those are of very, very small amounts. Okay, so such an amount is called as this threshold. Means something which is of no significance at all to the auditor. Yeah, any amount which crosses this limit, but which is up to again a threshold which is called as performance materiality. So I'm calling it as PM, performance materiality. Now such an amount is definitely crossing this small threshold, but that may be less than the materiality amount, or I can say that this particular window is all about an amount which is crossing the materiality. Now let's say for example, for this company having a turnover of 50 crores and say profit of 2 crores, materiality, let's suppose, has been established at say 50 lakhs. Materiality has been established at 50 lakhs. Now, any amount over and above 50 lakhs, okay, is into this bucket, or you can say this part. And any amount, let's suppose, which is say up to 1000 rupees, 1000 INR only, yeah, that is this amount. So this is very, very small, and auditor doesn't consider this to be important at all for his consideration. But any amount which is within this range is what? It's an amount which is below materiality, but that is also an error. Okay, so we are talking about this range now, which is within this range. Okay. Now, in respect of such type of errors, again, the perspective of the auditor will be very clear that all those errors should be corrected. So that means correct them in financial statements by passing the rectification entries. But at times, management may not want to pass any adjustment entries for that because of different reasons. Maybe management doesn't agree with the view of the auditor because the auditor may consider that to be an error, but the management may consider its position to be correct. Management may consider that whatever view management has taken on the basis of which accounting which management has done is correct as against the view of the auditor. So there could be difference of opinions of these two parties, number one. Secondly, even though management may agree with whatever auditor is saying, still the management may say that this amount is not very significant. So that's why we should not really disturb the financial statements, because it takes time for this financial reporting to be completed, and to make small changes at regular intervals may really impact the closure of the financial statements within the agreed timelines. So at times, management may also have a view of not passing these adjustment entries just to ensure that the timelines are met and the financial statements get closed within a particular timeline. And the management may also think that all of these adjustments are not so significant, so that's why there's not really a need to rectify them and to take care of not making the mistakes in the future periods. So these could be the reasons. Now, let's suppose if the management doesn't rectify these errors, and as we discussed, that the accumulation of all of these errors means the cumulative amount of all of these errors which are below materiality, that doesn't cross the materiality threshold, then auditor can accept this view of the management wherein the adjustment entries are not passed. But in such a case, auditor will have to ensure, and the management will have to ensure, that they provide all of these uncorrected misstatements in the representation letter. So that means the second course of action will be to put down uncorrected. So I'm calling these as uncorrected misstatements in the rep letter. Now, why is this important? This is again important for two reasons. One, the financial statements are the responsibility of the management. So they carry the responsibility of their preparation and presentation, and management has agreed for not making these corrections in the financial statements. So that means financial statements are going with these mistakes which are not material. So that's why it is not impacting the true and fair view. But when they will provide the representation to the auditor, they should comment on this. They should communicate this to the auditor in the form of a representation that these are the errors in the financial statements which have not been rectified. Secondly, it is also important on the part of the auditor to have this document from the management, because if we look at the working papers of the auditors, if we look at their audit files, all of those files will show this error, and will show this error which has not been corrected. So if there is an error which has not been corrected, then this requires some sort of documentation on the part of the auditor, which is only possible in the form of this representation from the management. So that's why this representation has to be there from the management side. This cannot be avoided. Clear? Yeah. Now let's come back to this point, and let's try to understand around these three thresholds, because some of you may have a confusion as to how to draw this line, because it's very easy to put down this amount of 1,000 and then this 50 lakhs, or maybe something below this 50 lakhs. See, as regards the determination of the materiality and as regards the determination of any of these thresholds, there's no fixed formula which can be prescribed for a particular type of industry or a particular type of company. This is all very, very subjective, and this depends on the judgment of the auditor. This also requires certain factors to be assessed. For example, what has been the past experience? That means in the past years, have there been a general trend that mistakes are made in the financial statements? Secondly, how strong are the controls of the company in respect of financial reporting? Because if the internal controls of the company would be strong, then definitely the chances of making the mistakes in the financial statements get reduced. And that's why auditor will also be more comfortable, because of which auditor may set up the thresholds at a lower level, or the auditor may not get into too much details in terms of its audit procedures also. So these are some of the bases through which all of these things are established. Secondly, in terms of establishing all of these amounts, auditor may also pick this amount on a head-to-head basis, means on the basis of the line item in the financial statements. For example, if we talk about revenue is such a large amount in the financial statement. So that's why if there are mistakes, say amounting to 50,000 for such a company, or let's suppose mistake which is ranging within 10,000, 15,000, 1 lakh, 1.5 lakhs, all of those mistakes can be easily ignored, because this is a very small percentage of the total amount of revenue. And considering the materiality, this can be ignored. But at times, there could be mistakes which may be related to the statutory balances. There could be mistakes which are related to the statutory records of the company. There could be mistakes which are related to certain documents of the company, wherein some of these thresholds in terms of amount may not be considered by the audit. And even if amounts are considered, amounts are required to be considered on the basis of the nature of the transaction. For example, if let's suppose TDS was not deducted and that's why not paid to the extent of rupees, or say amounting to rupees 10 lakh. Okay, so let's suppose this is an error. Now, TDS happens to be a statutory amount. TDS happens to be a statutory amount, and that's why even though this is below materiality, this may be considered to be extremely important, not only for the auditor, but the management may also appreciate such type of errors, even though those are below materiality, and may want to rectify all of those amounts in the financial statements instead of just taking them all of those amounts to the representation letter. Secondly, when we look at all of these materialities, all of these amounts in terms of the impact, at times it is also possible that some of the errors are compensating the other error. For example, in case of revenue recognition, let's suppose there is an error because of which revenue is overbooked by, say, 70 lakhs. It's crossing the materiality. But at the same time, we see an expense is also overbooked by, say, 30 lakhs. Correct? So all in all, if we look at the impact on the P&L, the impact is less than 50 lakhs. Because if we decrease the revenue, we'll also have to decrease the expense. So all in all, the impact is not really crossing the materiality threshold. Now there again, auditor needs a careful evaluation. Auditor needs an assessment. Because if we look at the gross amounts which are involved, they are not below the materiality threshold. The gross amounts are sort of, currently giving an amount, for example, this revenue which is crossing this 50 lakhs limit. So that's why it's very, very important that even though errors are accumulated and those are looked at in a cumulative manner in terms of the assessment of those errors, whether it's crossing the materiality or not crossing the materiality, even in that case, assessment of each and every error is very, very important on the part of the auditor. Okay. Now, this error could be because of anything, as we have discussed. It could be intentional or it could be unintentional. It could be for any reason. Another thing, other than reporting this matter in the auditor's report or taking this type of error to the representation letter, auditor, after his discussion with the management, would also require communication of these matters to those charged with governance. So that means in both the cases, whether these are corrected or not corrected, in both the situations, if you remember, will communicate all of these misstatements to those charged with governance. So that means in both the situations, communication will go to those charged with governance. Okay. Now this is something which cannot be avoided. This has to be communicated to the audit committee or for say a board of directors. Why? Because all of these errors are the one which the auditor has identified. And that's why these are considered to be audit adjustments rather than adjustments because of the preparation of the financial statements by the management. Okay. Yeah. So this communication again is very important on the part of the auditor, and this again will have to be taken to the document of the auditor. Now, again, one point may come that let's suppose if the errors have been rectified, correction entries have been passed, and because of which working papers have also got corrected. So if we look at the working papers, we will say that audit adjustment entry passed, and the conclusion is what? Conclusion is that the particular area is absolutely fine in terms of the audit procedures, in terms of giving the final opinion of the auditor. Then how do we really link all of these items to the documentation of the auditor? Now let's try to understand once again this point. Say if we continue with our example of revenue, wherein we said that revenue had a mistake of 70 lakhs. And let's suppose this mistake has been corrected. So the working paper of revenue will have this audit adjustment. So there will be a documentation of audit adjustment amounting to 70 lakhs. And because of which, so let's suppose this was an error and this is audit adjustment, and now the impact therefore is nil. So now there's no impact. Now when somebody will look at the working paper of the auditor, he would get to understand that there was an error in the working paper. There was an error which was recorded in the working paper and which was subsequently corrected. Okay, so that means working paper will give an audit trail. Audit trail in terms of error which got rectified. And that's why it becomes important that such audit adjustments are also separately documented in a file which will be about corrected misstatements. So we can say there will be another file of corrected misstatements, wherein all of these adjustments will be documented, all of them. And this file, or you can say this document, is something which should be communicated to those charged with governance. And that's why this working paper should also have a communication, should also have this documentation that this document has been communicated to those charged with governance. And that's why when you look at the presentation or the document which has gone to those charged with governance, that should have linkage to such audit working papers. Otherwise, what will happen? Let's suppose if we record those amounts, those correction entries only in this document, and which doesn't get reflected in the working paper of the relevant area, then there will be a mismatch, because the working paper will not show an audit adjustment and which has been shown to the audit committee, for example. So then there will be a mismatch, which should not be done. So this should always align with the working papers. Any final document which is kept in the file, any final document which is communicated to any of the authorities or the management internally as well as externally, should always have a proper linkage to the audit working papers. Okay, clear on this? Yeah. Now we can look at one example. Okay, so let's try to create a situation. Say, for example, a company is getting audited and auditor has identified certain errors. One error is, let's suppose, related to cost of goods sold. That means it's sort of related to inventory. And this error is approximately 5 lakhs. Yeah. Second error is, let's suppose, related to PPE. And on PPE, the error is, let's suppose, 15 lakhs. Okay. Then we, let's suppose, say the next error is related to, say, for example, if we talk about creditors, and which is once again related to, the recording of the creditors as against the purchases which were made from them. And let's suppose this amount is 2 lakhs. Yeah, so these 3 errors have been identified. Now the materiality for this company is, materiality threshold for this company is 5 lakhs. So 5 lakhs is the materiality of this company. Now, considering this situation, we need to comment out of all of these errors, which all errors should be corrected, which all should not be corrected, or what can be the final stand by the auditor, or what can be the final, decision of the auditor in terms of taking all of these corrections to the auditor's report or not. And we can just think about certain situations now. Option number A, is to correct. That means COGS and PPE. The rectification entry should be passed. Okay. Otherwise, qualify. Or instead of qualification, because we have not discussed qualification, otherwise report. Report means take this matter to the auditor's report. Option number 1. Option number B, all 3 errors. Okay, these should be corrected. Otherwise, we report. And in this option number 1, we can just say that for this creditors, nothing is required. Okay. For the creditors, nothing is required. Option number C. Option number C, we can say option number C, we can say PP should be corrected, and for other 2, nothing needs to be done. If rep letter is provided. That means if the other 2 matters are taken to the rep letter, then it is absolutely okay. Option number 4, that should be to correct COGS and PPE and creditors should go to rep letter. Yeah, and these, if not corrected, then we need to report them. Yeah, so I'll just quickly repeat all of these points for your understanding. Though Krishna has answered this, Jay, I'll come to your query. First point says that rectification entry should be passed for these 2, otherwise report, and for creditors we don't need to do anything, okay, because it's a small amount, so that's why it can be ignored. However, option number D is sort of similar. It says that these 2 should be corrected, otherwise report, but for creditors we need to take this matter to the representation letter. Then option number B requires all of them to be corrected, because they have a significant amount which is involved, so that's why it's important to correct, otherwise we should report. Option number C, it says PP should be corrected, okay, means the rectification entry should be passed for PP. For other 2, nothing needs to be done. If for other 2, that means COGS and creditors, rep letter is provided by the management in terms of not passing the adjustment entry. Now, out of these 4, which option do you think would be the right one? And Nagasai Krishna is saying option number B is perfect. That means all these adjustment entries should be passed. Sumit is saying option number C. Sumit is saying PP is okay. For other 2, it's okay even if it's not rectified. And Preeti is going with D. Preeti is saying option number D appears to be okay because option number D requires only the creditors can be ignored, other two need to be corrected. Yes, any other options from your side? We can go to the solution now. So now as regards option number B and C, which you have answered, let's pick up these two first of all. When we say all three, so all three, now if we talk about all three, so if we look at creditors, so creditors is something which is below materiality. So even if this is not crossing, if this is not corrected, it's good to go. So that means it's not a mandate. So auditor cannot have the reporting implication just because it's not corrected. Huh? So that's why option number B can be considered to be not correct. Yeah, J is saying option number A. Okay, J, I'll come to option number A also. Then talking about option number C. Option number C says PP needs to be corrected, but as around COX, let's understand, is that crossing the materiality? Of course, yes. Why? Because 5 lakh is the materiality. So if there is an adjustment which is in relation to this significant amount of the materiality, what will happen? This will impact the financial statement materially. So this will lead to a misstatement. Yeah, and that misstatement is material. So can this be ignored? No. So that's why this has to be rectified. Otherwise, this will have to be reported. So that's why option number C also goes away. Now coming to option number A and D, which require adjustment for these two. So these two should be adjusted. There is no doubt about it. But to say that for creditors we don't need to do anything will again not be correct. Why? Because we understand that if there is any error which has not been corrected, even though it's below materiality, still it will be important for that matter to be taken to the representation letter. So that's why when we say that creditor has an error, which is again not a small amount, that is also of significant amount, it may not be crossing the materiality. So that's why to say that we should not be doing anything about it will not be correct. So we will require to take it to rep letter. So that's why what should be the right option over here? The right option should be option number D. Okay, all of you clear? Jay is asking, sir, please explain again treatment of below materiality errors. Sure, so we can just understand that with the help of this example only. In our example, there is one error which is below materiality. And which one is that? The one related to creditors. And this matter is not something which is in line with COGS or inventory. It's other than that. That's why if this error is below materiality, which is clearly visible, huh? So materiality is 5 lakhs and this is significantly below materiality. So that's why what can we do? We can ignore this. Ideal scenario should be that the management passes a rectification entry for this. But if the management doesn't want to do that, it's okay. There's no problem. Because material misstatements are critical. But if this is not corrected, then can this be ignored? No. Standard says that if there are uncorrected misstatements, then all of such uncorrected misstatements should also be forming part of the written representation letter of the management. Auditor will have to take that written representation from the management in respect of errors which have not been rectified by the management in the financial statements. And that is again something which will form part of communication of the auditor to those charged with governance. Okay. Jay, clear on this? Okay, so with this, we come to an end to our discussion on this standard. you just let me know in case you have any query on this, and then we are moving on to the next standard. So now we will start with SA 500, and that is a very, very relevant standard that is about audit evidence. Something which will be of use for all of us quite significantly. Audit evidence. Jay is clear on this, and Preeti is asking, sir, is it always better to get the representation from the management for any error, however small it is? Definitely yes. But as I told you that generally you see the auditors setting a threshold limit which is called as clearly trivial threshold. So the errors which are below such a minuscule amount are ignored by the auditors, and that doesn't form part of rep letter also until unless those small errors on an accumulated basis also cross that particular threshold. For example, in terms of materiality, when we discussed, the materiality level was 50 lakhs and we set up this threshold of 1000. Remember? So maybe if the errors are of very small amount, 50 rupees, 500 rupees, 100 rupees, so all of those may be ignored. Auditor may not want to get into discussions of all of those matters with the management because that will be useless. Otherwise, the audit will not come to an end. But if there are so many errors of these small amounts related to a particular head, now again it's very important that if all of those errors are related to a particular head and cumulative amount of all of those errors is crossing this threshold, then once again, where will it go? It will sit in this category. Then we will not be able to say that this is clearly trivial threshold amount. It's crossing that limit. So that's why in that situation, it will again form part of representation letter. And one thing over which you may have a confusion is how to determine this amount. As I told you that there is no formula for determination of this amount. This is very, very subjective. This is based on the experience and judgment of the auditor. Yeah. So this may keep changing year on year, and this may also vary head to head. Okay, so now we'll move further. I'm just hoping, Preeti, you are clear on this. Now moving further on to SA 500, that is about audit evidence. On audit evidence, I would say so far, so many things that we have discussed were no different from what the standard requires. In very, very simple terms, what is audit evidence? Anything which the auditor checks or verifies or understands and at the same time documents. that will become audit evidence. You can also say that audit evidence and audit documentation, they go hand in hand. Why? Because let's suppose auditor has done the vouching of various expenses. Auditor has reviewed certain contracts. Now these tasks have been completed by the auditor, but nothing has been documented. So it's all in the mind, all in the knowledge of the auditor, but nothing has been put on paper, nothing has been recorded anywhere. So that means the documentation is incomplete. In such a case, can we say that the auditor will have the audit evidence? The answer will be no. So that's why till the time the auditor will not have any documentation, auditor will not be able to prove, substantiate that yes, there was an audit evidence or there is an audit evidence on the basis of which auditor has taken a final view, taken a final position. Correct? So what are we trying to understand? We are trying to understand that each and everything which is tested by the auditor is nothing but the audit evidence. So let's understand some terms. Accounting records. Accounting records could be invoices, contracts, anything related to books of accounts, say for example ledgers, say for example vouchers, any of the working files of the client, which could be related to say recording of the PPE, for example fixed assets register, which could be related to computation of say provident fund amount or say ESI amount, or which could be related to computation of salary for the months which the auditor is testing, which could be related to reconciliations which the management prepares as around the debtors balances which they may have. It could be related to various things. All of these records are what? These records are records of the management, records of the company. And the verification, examination, checking of all of these records will lead to audit evidence. But that will lead to audit evidence only when it gets documented. Otherwise, it will not lead to an audit evidence. Now, as around the audit evidence, if you remember, we discussed that the auditor's evidence, that means auditor's procedures should be performed in a way that auditor is able to get sufficient appropriate audit evidence. Okay. And we talked about these two, sufficient and appropriate audit evidence. Now, what is the meaning of sufficient? What is the meaning of appropriate? Sufficient is discussed with regard to the quantity of the evidence which is obtained by the auditor. Quantity means we can say the testing which is done by the auditor in terms of count. For example, for verification of sales, if the auditor has tested 25 samples, then it reflects the quantity which the auditor has tested. And the audit evidence in terms of the quantity gets reflected in the working paper by calling this as sufficient audit evidence. Means whether that audit evidence was sufficient or not with regard to that particular line item of the financial statements, or with regard to the importance of that line item in the financial statements. Now, how is this quantity decided? How is this sufficiency assessed? That is again dependent on the judgment of the auditor. there are few principles that we will discuss around audit sampling, which will also help us to understand around the sufficiency which would be required to be obtained. Means what should be the number of samples, how should the sample really be selected. All of these factors, all of these points will be helping us to understand around the sufficiency of the audit evidence. Because if the audit evidence is not sufficient, then the final conclusions which are drawn, and on the basis of final conclusions, the opinion which has been taken may not be right. Similarly, another very important part in respect of audit evidence happens to be its appropriateness. Now, quantity is covered under this sufficiency. The next aspect relates to the quality, because just by keep checking everything, auditor is not going to gain out anything. It's important to check the adequate number of samples. It's important to check multiple line items. But if the check is not really performed in a way that it will lead to the desired objective, then it's of no use. Okay. So like we say that quantity doesn't really matter. It's the quality also which matters, isn't it? So same is the case of auditor. Now for the auditor, the quality of the audit evidence is considered to be very, very important. Means whether it's relevant or not. Means if the audit evidence is obtained, let's suppose 25 samples have been selected for which a lot of documents have been obtained, but none of the document was really relevant in terms of the objective. Objective could be related to various assertions to be tested for the line item. Or we can say that the audit evidence has been obtained, but it may not be so reliable. And once again, if the audit evidence that is obtained is not reliable, then the auditor may not be able to form a view as around the truth and fairness of the of that particular item in the financial statements. Correct? Yeah. So both of these aspects therefore are important on the part of the auditor in terms of taking a final decision. So auditor needs to design and perform audit procedures that are appropriate in the circumstances for the purposes of taking a final view. Correct? Yeah. Now let's move on to some of the audit procedures once again, or the audit evidences, because audit procedures will lead us to the audit evidences. Okay. Now in terms of audit evidence, what can be the type of things which the auditor needs to look at? There are few things which become important over here. One is about the reliability of the data. It is always considered that when it comes to the reliability of the data or reliability of the information, then the information which is obtained from sources external to the entity would always be more reliable as compared to the information which is generated from within the organization. Okay, yeah. So let's understand. How is this possible? Or what are various factors which the auditor will have to consider over here? And it's all about the quality that we are discussing now. Now, evidences could be of two types, internal and external. As around the internal evidences, what can be those evidences which can be considered to be internal? Sales invoices which are issued by the company to its customers are what? Internal evidences. Okay. When the auditor will verify sales, what is the first thing he'll look at? First thing he'll look at will be the sales invoice. So can we say that this evidence is not appropriate? No, we are not saying that this is not appropriate. This is definitely appropriate. But over and above this, if we substantiate it by looking at some external documents, then the comfort of the auditor will get increased. So the auditor would be able to place more reliance on some of those external things as against obtaining only this invoice. So that means the quality of the audit evidence would be considered to be increased as against what he would have obtained over here. Okay. So let's try to see what can be those external evidences. Say if the company is in the business of supplying goods, means dealing goods. Then certain external sources which the auditor can check along with sales invoices could be e-way bill. Now, e-way bill, once again, is an internal document, no doubt, but this is something which is linked to certain external sources. Yeah, and which is also available on the portal of GST, wherein the auditor can go verify this. If the goods are supplied, then those will also be supported with the documents of transporter. So we can say transporter's documents. In respect of goods which are supplied can be looked at by the auditor, can be verified by the auditor. Now, if only sales invoice is available, then you can now compare as against checking of a particular line item of sale or a sample of sale, not only with sales invoice, but which is supported with these two. So when these two get added, what will happen? The comfort level of the auditor will definitely increase. Yes or no? Yeah. Number two, in certain cases, external evidence may not be available. So there are certain cases wherein the external evidence may be available. In certain cases, external evidence may not be available. So can we say that in such a case, audit evidence is not appropriate? The answer is no. It's not that the audit evidence should always be external or should always be supported with external sources. No. Audit evidence, if internally available, is also good enough. But auditor should always try to see if that can be substantiated or if that can be supported with some external documentation. That would help you. Another example could be related to depreciation. Say auditor is checking depreciation. Now for depreciation, what could be the document which auditor may want to check? Auditor may want to check fixed asset register of the company. This is one. Why fixed asset register needs to be checked? On the basis of fixed asset register, auditor will be able to verify which all items of PPE have been procured, which all items of PPE are there with the organization, what has been their useful lives, and what are the residual values, what is the location, etc. On the basis of which depreciation would have been computed. But this is internal to the organization, number one. Number two, management would also have done depreciation calculation, and this would again be internal to the company. So this is again not something which is supported by some external evidence. Yeah. However, there's one thing which the auditor would have checked, and in relation to this depreciation, one thing which the auditor would have checked would be the invoices of these PP items, because those are coming from the external sources. And when we say that that is not related to depreciation and that is actually related to PP, so that's why we may not really completely assign that to depreciation. Yeah. But with this, can we say that the evidence is not appropriate? The answer is no. Evidence is, even in this scenario, considered to be appropriate and sufficient also. Yeah, clear? Okay, now coming to the queries of Sumit. Sumit is asking, sir, would working papers become audit evidence? Of course, yes, they will become audit evidence because they will have the documentation of all the audit procedures. In fact, auditor will be required to keep a record of all of these documents because they are nothing but the audit evidence for the purposes of the auditor. And for the purposes of the audit which the auditor would perform, what would be the audit evidence? Various records of the company which he would check and document in his files. Okay, yeah. So audit evidence is definitely the records of the company, but those records of the company are nothing if those are not documented appropriately in the working papers. Sumit is saying, sir, what if in this scenario we discussed about goods? What would happen if there was no goods, but it was about supply of services? Okay, if the services were rendered. See, there again, it's not that we will be limited to invoices. Auditor will look at the contract with the customers, because that contract is not only internal, that contract would have been signed by the customer. And if the contract is signed by the customer, then that is also sort of supported in terms of some external evidence, which would reflect the scope of work, which would reflect the period of the work on the basis of which invoice would have been raised. Yeah, so there are a lot of documents which may be looked at by the auditor in terms of his checking. Jay is then asking, okay, Jay, I'll come to your query of this bare text, etc. later on. Jay is asking, sir, purchase bill of fixed assets can be verified over here? Of course, yes. And then he's saying, sir, physical verification can also be done. Of course, yes. But as we discussed, that these are all sort of attributed to PPE rather than depreciation. But yes, to a certain extent, depreciation will also be computed correctly if the PP would be recorded correctly. Yeah. So to a certain extent, that would be correct. Okay. Yeah. Just give me 1 minute. I'll just look at your phone. Okay. Now moving further on to the evidences. Now, depending on the audit procedures, evidences may be gained. Now, what can be the various audit procedures? When the auditor would start his work, auditor would obtain an understanding about the business of the company, about the industry in which the company operates, about various processes of the company, All of these would lead to what? Audit evidence. When the auditor makes inquiries with the management, inquiries with various employees of the company, inquiries or discussions that the auditor would have done with those charged with governance, that would again give audit evidence to the auditor. Yeah, that would again give audit evidence to the auditor. When the auditor would do this verification, etc., this verification of invoice or verification of these type of documents, this would again give the audit evidence. When the auditor would review the ledgers of the company, when the auditor would review the financial statements of the company, when the auditor would perform analytical procedures on various line items of financial statements of the company, and on the basis of those procedures, the inquiries or the discussions that the auditor would do with various personnel of the organization, that would again lead to what? That would again lead to audit evidence. Okay. Now, this audit evidence at times may not be limited to company's personnel. They may go beyond this. For example, management may have engaged its expert for the purposes of for the purposes of some competitions, or for the purposes of any item which may get recorded in the financial statements. A very simple example around that could be actuary. Actuary would be an expert of the management. And what would be the role of the actuary? The role of the actuary would be to do the computation of employee benefit in terms of, say, gratuity, or in terms of, say, compensated absences, or in terms of, say, warranty at times, and which may get recorded in the financial statements. Now, there is a separate essay which deals with procedures required on the part of auditor when it comes to management's expert. But just touching upon that as of now, that whenever management will have such experts who are involved, auditor may get into discussions with them. Auditor may get into certain procedures, okay, which may be executed by the auditor in direct by having a direct communication with those experts. And all of these communications, all of these discussions will once again lead to what? Will once again lead to audit evidence. Similarly, other than the management experts which may be involved or which may be engaged by the management, auditor may also get into external confirmations. And this external confirmation is all about obtaining the evidence from external sources, means from sources outside the organization. For example, bank balances. In relation to bank balances, when the auditor will do the verification, one thing which the auditor can obtain from the internal sources will be the bank statements. Yeah, auditor will obtain the bank statements. Bank statements in respect of transactions which have been carried out during the period, or in respect of the balance of those banks as at the end of the year. Correct? Other than that, auditor may want to reach out to the banker directly by sending a balance confirmation to those banker, on which again we'll have a separate discussion. Now, even though this balance confirmation may have been obtained by the management also, but still auditor may want to send this confirmation to the banker on his own directly, so that the banker responds to the auditor, and that would again lead to a situation wherein for a particular line item, auditor has obtained the information internally as well as externally. Correct? Yeah. Clear on this? So this was something about the appropriateness, or something which was in relation to the quality of the audit evidence. Other than that, as we discussed, that it also requires quantity to be assessed by the auditor. Quantity in terms of what is required to be tested, what is not required to be tested, and if that is required to be tested, then what should be the line items, or how many records are required to be verified by the auditor. This is all about quantity, or you can say sufficiency. Now, this all comes down to one aspect, and that is about, I would say, sampling. Now, there could be certain line items on which auditor may not perform sampling. And on sampling, we are saying that out of various line items, auditor may perform test on some line items, and in certain cases, auditor may want to check each and everything. Let's understand with the help of few examples. Say a company having a revenue of rupees 2 crores. Yeah, but the company is into retail, so that's why they have large volume of transactions. And the number of invoices are too many. Now, in this situation, can we expect the auditor to check each and every invoice, each and every document related to each and every transaction? No, that is not expected. And that is not the role of the auditor at all. That is not expected out of auditor at all. He is not required to do that. So that's why in such a situation, what would the auditor do? He will not check everything. He will check only few things. And how are those few selected? That is again judgmental. That is based on judgment of the auditor. Auditor will have to check what he will want to look at and what is it that he would want to not check. But there could be few items wherein auditor may want to check everything. For example, if we look at the computation of depreciation. Let's suppose on computation of depreciation, auditor wants to perform a procedure called as recomputation. Okay. Now, auditor is not checking the samples. So what is he doing? He has obtained the working file of the client wherein depreciation has been computed, and he will apply the formulas, etc., in that working file on his own. So when he will do this, will the auditor do this on sample basis? Not generally. He would want to recheck the formula which has been applied in the file by just, recreating that formula and putting that on all line items. And if the formula is fine, then the entire computation would be okay. So therein, auditor in a way would have checked the complete calculation of the depreciation. Similarly, it would be judgmental on the part of the auditor as to which all items he would want to check 100%, which all items he would want to check only on a sample basis. Clear? All of you? Yeah? All of these things would eventually lead to what? Audit evidence. And as we have discussed, that in terms of audit evidence, it's very important that the auditor obtains evidence which is sufficient and appropriate. Okay, clear on this? Yeah. So now I'll just continue with this sort of topic, and I'm just moving on to the next auditing standard, which is a kind of continuation of this audit evidence, SA 501, which basically deals with this aspect of audit evidence in relation to certain specific items. And these certain specific items include inventory. And with the help of this inventory, you can also say, now this becomes an example as for us for the purposes of our discussion related to audit evidence. With the help of inventory, we will try to understand how would the audit evidence be obtained and what are those special areas which the auditor will have to consider while auditing inventory. So let's pick up this inventory and let's try to understand various procedures that are possible around it. Inventory is considered to be a very important item for any company because this may significantly impact the profitability. This may significantly impact the operations of the company. And that's why this will be one area on which auditor will have a focus on, and this is also in most of the cases considered to be an area which will have significant risk in terms of the risk assessment by the auditor. Okay. Now, because of the importance of the inventory, certain procedures around inventory become very important or crucial. And all of these procedures as around the audit evidence or as around anything are always looked at from the perspective of various assertions. You remember, we need to go on the basis of assertions when it comes to testing of anything or when it comes to procedure by the auditor. For inventory, one very important assertion happens to be existence. And let me just see if any of you would want to comment on this assertion and would want to let me know as to what would be the audit procedure in relation to this assertion. Sumit has asked me one query that sampling is also based on materiality. Yes, of course. Sampling is based on materiality as well as the judgment of the auditor. Now, as around existence, now this particular aspect related to inventory regarding its existence could be a significant risk for the auditor. That means when the auditor did the risk assessment at the time of planning stage, he may have considered existence of inventory to be a significant risk. And because this was considered to be a significant risk, that's why auditor would have planned certain procedures around it. And Anjali and Jay are saying that it comes to physical verification of inventory whenever auditor will be dealing with the existence of inventory. Now, this particular procedure of inventory is considered to be very important. Why? Because it may happen that the company doesn't have any inventory physically available with them, but those have been recorded or shown in the books of accounts. And what can be the procedure to check existence of inventory? If we look at the invoices, can we say that the inventory exists as at the reporting year end? For a company having 31st March 2020 as the year end, if the auditor verifies the invoices, that means the purchase invoices. Can the verification of purchase invoices be the relevant procedure for existence? No, because the inventory may have been purchased and sold, may not exist, may have been purchased but not physically received. So that's why for existence, purchase testing will not help. Can we say that whenever the inventory is purchased, along with purchase of inventory, there is also a goods receipt note? Many organizations prepare this, called as goods receipt note, and it's known by different names, which is then moved to the stores or the warehouse, which is then moved to the production and at various places. Can we again say that if the auditor verifies that document, then the existence assertion can be tested? Once again, no, because all of these documents do not substantiate, do not help us, the auditor, to understand whether the inventory exists as at 31st March 2020 or not. That's why there is only one procedure which will help the auditor for this existence assertion, and that is its physical verification. Physical verification of the inventory is considered to be a very critical procedure and which no auditor would want to skip. And this procedure is required to be performed at year end or near year end. Why? Because whenever inventory is recorded, it's the year end balance. And that's why to verify that that inventory existed at the year end is important. It's not that inventory can be verified at any point of time in the year. It should be as at the year end. And that's why for the purposes of existence, auditor would actually go to the place where the inventory is kept along with the management, and auditor would physically count that. He would do a stock take. Yeah. So this is known by different names: stock take, physical count, stock count, physical verification. So there are different names through which this is known. All of these are required to be performed by the auditor near year end. Now, this physical verification of inventory doesn't mean that physical verification has to be done on 100% basis. Now, therein, auditor needs to do his assessment on the basis of the inventory type of the company, means the nature of the inventory which the company will have, the quantum of the inventory, the volume of the inventory. Because if the volume is significant, then the auditor may not physically verify 100% inventory. Because to count each and every item of the inventory on 100% basis may not be required on the part of the auditor and may not be really something which the auditor plans to do. But yes, auditor may want to check each and every type of inventory which is in place. And that's why generally what we see is that auditor would do ABC analysis. What is this ABC analysis? Auditor would always categorize inventory items into three parts: A, B, and C. Category A would include inventory items which are of high value and on which auditor would do more testing. Auditor would pick up the auditor would verify more items as compared to B and C. C would be the low value items. It doesn't mean that the auditor would ignore B and C altogether. But because A would be the high value items, so that's why this would cover a significant part of risk of the audit. Because if majority of the inventory is covered, then of course the risk gets minimized. Correct? Now this is something which the auditor may do on his own, and at times for the physical verification of the inventory, auditor may also want to engage an expert. Let's understand why would that need arise. At times, inventory may be of such type over which some expertise is required. See, auditor is what? Auditor is an accountant. Auditor is a chartered accountant. And auditor may not have the technical expertise in relation to certain types of inventories, which may not be counted just by having that knowledge which is gained on the basis of whatever auditor would have studied. For example, some of the inventories related to steel industry, they require some experts to be involved because of the nature of the inventory. The nature of inventory is not something which can go and count. It requires measurement. And for the purposes of this measurement, experts are engaged generally by the management also. And because the management engages the experts, so that's why to understand the measurement criteria which they would have been following, to understand the way they would be taking the stock count along with the auditor, it's important at times that the auditor also involves his own expert who is able to then understand what is the measurement criteria which the management has followed and what should be the measurement criteria. But if the auditor just goes by whatever management would have done, it may not be right. And this doesn't necessitate the requirement of an expert by the auditor. This is again something which the auditor will have to assess, whether he will be able to handle that or not on his own. Correct? Yeah. So we can say, depending on the nature of the inventory, auditor may perform this stock count himself or may engage an expert. And this expert is not the expert of the management. This expert is the expert of the auditor, which is also called as auditor's expert. And once again, on this auditor's expert, we have a separate standard and we'll have a separate discussion around this auditor's expert and management expert. For us, for the time being, we need to sort of focus right now in terms of our understanding of various procedures which are performed. Next aspect is, at times the inventory of the company could be huge, means the volume levels could be high, wherein we may say that because the volume levels are high, so that's why we are doing this ABC analysis, wherein we are focusing more on A items or category A items as compared to category B and C items. But still, it may not be easy for the auditor to handle it during the course of his audit only at the year end. Okay, yeah. In such a situation, instead of just doing the physical verification of inventory at the year end, and this is something which generally the large corporates do and who have got huge volumes of inventory, they keep doing this visual verification throughout the year. And it doesn't mean that the same inventory is counted throughout the year. No. That means it's a rolling cycle which they follow. For example, a company, let's suppose, has got various items of inventory and the volume levels are very high. So what would the company do? Company may divide this process of physical verification of inventory on the basis of nature of inventory. Means in the first quarter, they plan to verify certain items or certain categories of inventories. In the second quarter, they plan to verify in terms of physical verification of inventory, next categories. Then in the third quarter, more categories of inventories, and in the fourth quarter, then again. And this is how this process keeps going on. Because let's suppose if this entire stock count would be performed at the year end, it may take, say, many days. It may run into this this process may, let's suppose, run into, say, 30 to 40 days. At times it's possible, yeah, wherein it may become very, very challenging, not only on the part of the management but also on the part of the auditor, to handle that stock count at the year end only. Yeah, so that's why whenever any such process is followed by the management, it's okay on the part of the auditor, but the auditor will then have to assess, will then have to design his audit procedures so that he is able to check, he is able to come to the conclusion around the physical existence of the inventory as at year end. And how will that be done? By doing roll forward or roll back procedures. What do we mean by roll forward or roll back procedures? Let's suppose inventory is counted on 29th of March. Physically counted on 29th of March. Now, what would the auditor need? Auditor needs the inventory as at 31st March. Now, for this, because he has this physical count available as of 29th of March, so that's why he would check all the issues, all the receipts in relation to inventory from 29th March to 31st of March, which is called as roll forward procedure, on the basis of which he will reach to the inventory of 31st of March. Similarly, if the inventory is physically counted, let's suppose on 4th of April, and the auditor requires this inventory as at 31st of March. Now, in this case, what would the auditor need? Now, in this case, auditor would need to roll back. So now what would he do? On the inventory which he has physically counted, he would deduct all the receipts and he would add all the issues from 31st March to 4th of April. And on the basis of which he will be able to reach to the inventory of 31st of March. This is called as roll forward and roll back procedures. And these procedures are also very, very commonly done, because in most of the cases, entire inventory doesn't get physically counted on 31st of March itself. It's near around year end that it starts, and it goes on for a few days or maybe 1 or 2 days, at times for 1 day only. Yeah. So depending on the process which is followed, it goes on. Another type of situation which may arise in case of inventory could be the inventory which may not be lying at the premises of the company, which may be lying at third locations. Third location means locations which do not belong to that of the company. Now, there again, judgment of the auditor is required, whether the auditor considers the need important enough to visit those locations also, which may not be the locations of the company. If that is necessitated, auditor would do that. And auditor would want to visit those locations on a sample basis, also do the physical count over there. Or otherwise, auditor, instead of physically verifying, instead of going there and physically doing this count, auditor may obtain confirmations from those third parties in respect of inventory which would be lying there. And that again is dependent on the comfort of the auditor, the processes which the management follows, and also in terms of the controls which the management may have, because that will give an assurance to the auditor that the inventory is actually lying at those third locations. So that's why generally you will see the auditor picking up at least few locations of the third parties also, to ensure that inventory actually exists over there. Okay, clear on this? Yeah. So as around inventory, the most important procedure happens to be this physical verification. Yeah. Now I have this query from Anjali. Anjali is saying, let's suppose if the inventory is with job worker, then can we have direct confirmation? I think I just answered this query of yours. Job worker is nothing but that third party. Huh? So therein again, it's up to the auditor. As I told you, if there are so many job workers, then auditor would definitely want to visit one of the job workers and do the physical verification. And there again, it will be dependent on the controls of the job worker, because job worker may have inventories of various parties. Now, how to identify the inventory of this particular client? If that is possible, auditor will physically verify this. If that is not possible, then the auditor may have to just rely on the confirmations which is obtained from job worker, and that should also be good enough because that is an external confirmation. Because job worker is not the party of the company, that's a third party. So that is also acceptable, and this is something which you see in the normal course. All right, clear on this? Now, other than that, there is this standard basically talks about a couple of more items on which certain procedures are considered, and these are considered to be specialized items. So that's why this SA 501 specifically deals with those situations. Now, what we can do is, before we move on to that, we can take a break of 5 to 10 minutes, and after the break, we will continue with our discussion on 501, and we'll start with this procedure on litigations and claims in the when we meet next. Okay, yeah. So let's take a break now. Hi. So we'll now continue with this auditing standard in terms of litigations. We were talking about that there's again a specialized area which this standard covers. Now litigations and claims is all about some of the disputes which may arise and which could be related to various matters. And this is a specialized area because this again requires a lot of judgment on the part of the auditor, and this is again not something which is very scientific. So let's understand what can be the various things which the auditor may want to cover during the course of his audit in relation to this particular line item. We may take the help of an example of litigation related to taxation matter. Tax litigation. Say a company has received a demand from income tax in relation to its assessment for a particular year. Now this demand at times may not be agreed with the company. So that means company may dispute the demand of the department, and because of which this amount may not get recorded in the financial statements. This amount may or may not be paid by the company. That depends on the legal requirements, because at times law requires that certain portion of the demand is required to be paid, and then the company may get into the litigation. And that's why company may have to deposit this amount with the department and then continue with the litigation. And at times this amount may not be deposited at all. So that means whether the amount has been deposited or not doesn't matter. For us, the point of discussion is about that tax litigation which has been going on. This is one. And this is about those tax litigations which are known to the auditor. So we are saying this is known to the auditor. Similarly, there could be other litigations. So we can say tax litigation 1. There could be other litigations. Litigation number 2, which may also be going on in relation to any matter, but which may not be known to the auditor. So we are saying it's unknown. Unknown or known, we are talking only in the context of auditor, because the management knows about it, but the management didn't bring this to the knowledge of the auditor. And why is that possible? See, this is possible because auditor may want the management to recognize this amount in the financial statements, and whenever this amount gets recognized in the financial statements, this will increase the liability and the expenditure, which the management may not want to do. And that's why at times management may not want the auditor to know about such litigation which is going on, till the time it's reached a particular level, till the time management is sure about its outcome. So that's why another procedure which becomes important on the part of the auditor is how to get the knowledge of such type of litigations. Because in respect of the books of accounts, they may not have any trail available with them. Okay. There can be another litigation which is quite similar to of this type, means which has been going on and which has also not been made known to the auditor, but for which some trail may be available in the books of accounts if the auditor performs his procedures appropriately. So we are saying this is again unknown to the auditor. Now let's try to understand one by one what could be the various procedures on the part of the auditor in relation to all of these litigations and claims. See, the first step which the auditor would always want to do would be to have discussions with the management, inquiries with the key personnel of the organization, go through the minutes of the audit committee meetings, board meetings, because therein all of the critical matters like these would have been discussed, so that the auditor comes to so that this knowledge of all of these matters is brought to the is something which can gain. Number one. Number two could be the review of the legal expenses of the company. Generally, for every type of entity, legal and professional expenses are considered to be extreme importance. Why? Because if the auditor would review that properly, review means scrutinize those expense ledgers, go through the expenses which have been incurred by the company. Maybe a company has paid fees to a lawyer. And why is that fees paid? If the auditor wants to understand that, then the auditor, on the basis of his understanding, may get to know that a litigation has been going on, for which lawyer was hired. Yeah. So some of these litigations, some of these disputes which would have been going on may have such type of audit trails available in the books of accounts, and which is possible by reviewing the legal and professional expenses of the company. Similarly, auditor may also get into the documents or the records available with the company, like board minutes, etc. And third aspect, which is of very importance, that is about communication with legal attorneys. And this is again a kind of external confirmation. External confirmation. And what is this external confirmation? The auditor would reach out to the legal attorneys of the company, the lawyers of the company, who may be involved in various litigations, various legal matters related to the company. And the auditor will not send any balance confirmation. No. Instead, the auditor would send a list of cases, or maybe an open letter to them, wherein all of those legal attorneys would be required to respond to the auditor directly about all of the legal matters which they would have been handling on behalf of them, on behalf of the company. Now, this procedure is considered to be extremely important. Why? Because this will not only bring to the knowledge of the auditor those matters which he may not be knowing. This would also confirm about the status, about the details of all of those matters which would have been going on and which were also made known to the auditor by the management, but for which more clarity would be provided or more clarity would be received by the auditor after having such communication with those legal attorneys. Auditor may then want to have discussions with those legal attorneys in respect of their assessment as to the outcome of those legal matters, those legal cases. Because at times, management may, let's suppose, may have disclosed this as a contingent liability. Let's suppose management may have disclosed this as contingent liability. Yeah, because the management may have disclosed this as contingent liability, the auditor may want to know whether the outcome of this particular matter would only be something that should be disclosed as a contingent liability, or whether the outcome of this matter would be unfavorable to the entity, and because of which this should not really be treated as a contingent liability. Rather, this should get provided in the financial statements. So this assessment of the auditor would be supported on the basis of the discussions of the auditor with the external parties who have been involved in these matters. Now here again, auditor would generally want to bring in his expert, and this is something which you generally see. Auditor would not be handling all of these matters on his own, because auditor would also have specialization. Let's suppose if the auditor is there, he would have specialization, say, of audit, or he may have the specialization of, say, accounting, but he will not have the specialization of each and every area. If the matter is related to, let's suppose, say, income tax, if the matter is, let's suppose, say, related to indirect taxes, he may not have the expertise. Or if the matter is related to, let's suppose, of a particular law, auditor may not have the expertise over that particular over that particular matter, and therein the expert of the auditor would support the auditor in terms of assessment of the outcome of all of these cases, so that their outcome can be properly determined and can be checked whether the outcome which has been assessed by the management is in line with what the auditor should assess. Secondly, if any adjustment is required to be passed in respect of these matters, that can also be made there. Okay, clear? Another item which this standard focuses on, and one on which special procedures have been prescribed, is all about segment reporting, segment information. Now, segment information is what? If you know about segment information is all about disclosures related to segments of the company in the financial statements. I have this query from Jay. I'll just answer this query before moving on to this segment. Jay is asking, sir, will the inventories be counted at year end? Only because if counted half yearly, quarterly, very difficult to reach 31st March figure. Of course, yes, this happens to be one of the reasons. Okay. Now coming back to this segment information. See, on this segment information, there is an accounting standard. That accounting standard requires disclosure of segment information. Now, what is this segment information? Segment information means if a company is dealing into, let's suppose, various products, or let's suppose different business lines, which may qualify the criteria of segment as per those accounting standards. Okay, so we don't need to get into those accounting standards, but of course, auditor should have knowledge of those accounting standards. Now, what is the role of the auditor? The role of the auditor is very simple: to ensure whether that segment information has been appropriately disclosed in the financial statements or not, in line with the requirements of the accounting standards. For example, a company may be, let's suppose, manufacturing furniture, and the company may also be, let's suppose, trading into certain equipments. Now, the company has got two business lines, and these two business lines are different in terms of the nature of products also. Now, because these are two different product lines, or these are two different business lines, so that's why the company may have these two different business lines as their separate segments, on which certain segment information is importantly required to be disclosed in the financial statements for better understanding of the users of the financial statements. Now, how would the auditor assess this? First of all, auditor would have to evaluate the disclosure which is given by the management, whether that is in line with the requirements of accounting standards or not. Whether the requirements of accounting standard in respect of all the disclosures in relation to segment information have been given or not. Auditor may also perform some sort of analytical procedures in respect of various business lines which the company may have. Why? Because in terms of assessment of profitability of the overall company, one segment may be having losses and the other segment may be having profits, and it may happen then on a net basis, means when these two are combined, company is showing a profitability, but actually one of the segment is making losses. And that's why some of the analytical procedures which the auditor may want to perform may have to be bifurcated depending on the information related to the segments. And that's why this segment information, segment data, auditor will have to carefully evaluate, auditor will have to carefully assess. Otherwise, this may lead to some wrong assessment on the part of the auditor. Secondly, even if we talk about some of the analytical procedures, those are all based on information provided by the company. So that's why the information which is provided by the company may also be required by the auditor to be again divided into two parts. So that's why auditor may want to do his sample selection on the basis of different business segments. Auditor may want to increase his sample selection, one which is based on say manufacturing line and second is based on say trading line. Yeah, so this is again one area wherein the auditor's procedures in terms of quantity as well as quality will have to be assessed based on the segment information. And of course, not to forget that this entire segment disclosure has to be in line with the requirements of those the applicable financial reporting framework. Now, this can be dependent on anything. And I understand for all of you, it's all Ind AS which are relevant at the final level. But of course, in terms of the accounting requirements, there are a lot of similarities. So as around our audit procedures, they don't really vary too much. Okay, clear? Now, this is all about audit evidence. And as we have discussed that this standard basically deals with certain items on a specific basis. That doesn't mean that the other items are not so important. Those are also important. It's just that these items had certain peculiar procedures which were discussed in more detail in this standard. But even if we talk about any other standard, and if that standard talks about any of the audit procedures, that is nothing but will lead to audit evidence only. All right, clear on this? Yeah. So now we can move on to our next standard. We will now move to a very important standard, I would say, SA 505, that is about external confirmations. And before we start this, if you have any questions, any doubts, please let me know. And we'll have many examples to discuss on this. SA 505. Okay, so moving further onto this essay, very important essay. because we have spoken about it. We have spoken about external evidence, and it's all about obtaining that external evidence only. External confirmation. So let's first of all understand the meaning of external confirmation. Though we have briefly touched upon this, but still it will be important to understand the meaning of external confirmation, and then we'll pick up certain examples to discuss with external confirmations in more detail. And this is very, very interesting topic, and at the same time very, very important topic. Plus, this is also one of the areas of audit which we have seen is neglected. But because this is neglected, so that's why it may become a huge risk for the auditor in terms of his audit documentation. So let us first of all talk about the confirmation. So what is a confirmation? Audit evidence obtained as a direct written response to the auditor from a third party in the form of a paper, that means hard copy, soft copy, that means electronic or any other form. And let's take an example. We discussed about bank balances, if you remember. So auditor is sending a balance confirmation to a bank. In addition to what the management would have done. And then the bank responds to the auditor. Okay. This is called as external confirmation. Now, this external confirmation could be positive or negative. Let's understand what do we mean by positive confirmation request or negative confirmation request. A request that the confirming party respond directly to the auditor, indicating whether the confirming party agrees or disagrees with the information in the request or providing the requested information. This is called as positive confirmation request. Next is about negative confirmation request. A request that the confirming party respond directly to the auditor only if the confirming party disagrees with the information provided in the request. Okay, so these are two types of confirmations that we get to see. So let's again take an example to understand about both these type of requests, positive and negative. When the auditor reaches out to the bank, auditor writes in his balance confirmation that please confirm balance of rupees 1 lakh. So with this bank, company is showing a balance of rupees 1 lakh. So auditor is requesting the bank to confirm balance of rupees 1 lakh. Okay. This is called as positive balance confirmation request. Why? Because in this case, bank would be required to respond back to the auditor. Even if the balance is of the same amount, still bank will have to send a response letter. Okay. As against this, let's suppose if the auditor sends a letter to the bank saying that you are required to respond only if the balance doesn't match. And this is something with which I'm sure you will be able to relate. I'm sure you would have looked at your bank balance statements. If not, you may just look at your bank balance statements or the bank statements. See, whenever the bank provides you the statement, at the end of the statement, there's a note which is given that if you don't confirm the balance, or if there is any discrepancy in the balance which is given in the statement, then you are required to respond within 7 days. If you don't respond within 7 days, then it will be considered to be all right. Okay. This type of confirmation is called as negative confirmation, wherein we respond back only when there is some discrepancy, otherwise not. Otherwise, it's presumed that the balance which has been provided in the form of that letter is correct. Okay, yeah. Now, whether this confirmation which the auditor will send will be a positive one or a negative one will again depend on different circumstances. Generally, we get to see that the auditor sends positive balance confirmation requests. And let's now try to understand this entire process of external confirmations. Because these confirmations are sent to the external parties, that's why they are considered to be external confirmations. So let's now try to understand the process which is involved here. So we have the auditor over here, then we have the management of the company. Management of the company means the company which is under audit. Auditor of the company, and then we have bank. Bank with which this company is maintaining its balances. Okay, so it's not the bank of the auditor. Okay, it's in relation to the company that we have been discussing. Now, at the year end, company would be showing some bank balances in its books of accounts, for which company would be doing some reconciliations on the basis of bank statements or bank balance confirmations received from the bank. Correct? Yeah. So these two documents, or either of these two documents, company would have obtained from the bank as at year end. And let's suppose we are looking at 31st March 2020. Company would also provide both these documents to the auditor. Who will provide? Company will provide. It will not move from the bank. It will be provided by the company. When the company shares these documents to the auditor, what do they become? They are evidences which are obtained internally. Even though these are statements of the bank, still these evidences are obtained internally, so that's why they are considered to be internal evidence. Okay. Over and above this, auditor would also want to reach out to the bank directly. And how would the auditor do this? In terms of his communication, auditor would send a balance confirmation to this bank. So auditor would roll out a balance confirmation to this bank. But before this balance confirmation is rolled out, auditor would require approval from the management of the company. So I'm just removing this part now. Now, because it's the bank with which company is having transactions, company is maintaining the bank accounts. That's why before the auditor communicates with them, what would the auditor need? Auditor would need consent of the management. So auditor would reach out to the management for its consent so that auditor can communicate to the bank. Management would provide the consent to the auditor that yes, you may feel free to reach out to the bank for obtaining the balance confirmations. Once the balance confirmation, once the consent for rolling out the balance confirmation is obtained, what would the auditor do? Auditor would start sending those confirmation letters to the bank. All of these letters which will go to the bank will be on behalf of the auditor, and all of these letters will be on the letterhead of the company, because auditor is doing this audit for the company, correct? But who will send the letters? Auditor will send the letters to the bank directly, wherein the auditor would request the bank to confirm the balances or all the balances which this company would be having with them as at year end. Okay. Now, along with this, auditor would also send a request letter wherein the bank would be required to respond to the auditor directly in respect of the balance which the bank would be having for this company. So now, as a next step, what is it that the banker will do? The bank would respond directly to the auditor. So there will be a direct response from the bank to the auditor. Okay. Now, why is this important? And what's the relevance of this? This will become independent assessment by the auditor, and this will be independent of the management, because there is no intervention of the management in respect of evidence to be obtained. Now, this is what? This is again about obtaining evidence. So now this evidence which the auditor is trying to obtain is from the bank, and that is independent. There is no involvement of the management over here. Correct? Now, various situations are possible in this process. Let's try to discuss each and every situation which is possible. Sumit is saying that this SA 505 is very, very significant. Of course, yes, this is very significant. Anjali, I'll have to come back to your query maybe towards the end of the session. Huh? Just please remind me for this in case I miss out. So let's understand various situations. Practically, to perform this external confirmation procedure is very challenging. Why? Because a company may be dealing with many banks, company may have various bank accounts. And if you look at large companies, even the small, medium-sized companies, they may be having 30 to 40 bank accounts very easily. So that means auditor will require a lot of coordination. And these 30 to 40 bank accounts may be spread across locations, spread across India, at times, in relation to operations, it may be different banks with which the company may be doing the transactions. So first challenge happens to be the coordination, of course, the biggest challenge. Number two, it may happen that the auditor has reached out to the bank, auditor has sent the request for balance confirmation, but the bank doesn't respond. Okay, now what is the course of action in that case? If the bank doesn't respond, what would the auditor do? Auditor would send a reminder. Auditor would send a reminder. A letter of reminder would be sent by the auditor. It may happen that even with the reminder, bank doesn't respond. Now what would the auditor do? Auditor would send another reminder. Okay. But during this process, when the response of the bank is getting delayed, what would the auditor do? Auditor would also reach out to the management and request the management to request the bank to respond to the auditor directly as soon as possible. Because this entire process otherwise would delay the completion of the audit. Okay. Yeah. Auditor has to obtain all these balance confirmations from the bank. There's no exception which is possible which the auditor may have in respect of obtaining the confirmation from the bank. Yeah. Number two, next challenge and the next problem which may arise. Next challenge is the bank responds, but the balance which the bank shows happens to be the different which the company has recorded in its books. Let's suppose bank shows a balance of rupees 1 lakh, but company has recorded, say for example, 1 lakh 10,000, which in case of a bank should not arise, but still it's possible. Now what would the auditor do in this scenario? In this scenario, auditor would first of all reach out to the management to discuss the reasons for these differences. Okay, now the auditor would reach out to the management to discuss the reasons for these differences. That means auditor would make inquiries in respect of these differences, and auditor would therefore want reconciliation, or we can say a sort of revised reconciliation from the management in respect of this balance which the bank has confirmed to the auditor directly. Correct? Yeah. On the basis of the reconciliations which now the management would provide, auditor would perform his additional procedures. Means auditor would perform testing of those reconciliations. Auditor would check what are those line items because of which there are differences. And all of these reconciliations would form part of audit documentation. And not to forget that this entire process which will require dealing with various banks will be a big task on the part of the auditor. So that's why auditor will generally have a separate team member who will be looking into this entire process. Now, if you look at the large firms, they have generally a separate dedicated team who takes care of this process. Okay, because a lot of coordination is required and a lot of time is spent on this entire process. Yeah. Next challenge could be in relation to balance confirmation which is not obtained at all. So in certain scenarios, it may happen that the balance confirmation is not received. So the auditor has sent the reminders, but still the balance confirmation has not been received. And please note it that all of these balance confirmation requests which the auditor will send to the bank will be in hard copies. And the bank will also respond to the auditor in hard copy. Now, after the multiple follow-ups, etc., after the multiple reminders which may go out, what the auditor may request to the bank would be to confirm around these balances over email ID to the bank, to the auditor, on an exception basis. At times, another challenge is seen that banker has responded, but instead of sending the response to the auditor directly, banker or the bank responded to the management. So it's the same request letter of the auditor on which the bank had to respond. Instead of sending it to the auditor, bank has sent this to the management. So will that work? The answer is no. In that case, it will be considered as if the confirmation has not come to the auditor, because the bank has to respond to the auditor directly always. If that is not done, then this confirmation letter is of no use, because anyways the company would have balanced confirmations with the bank separately. Herein the idea is what? Idea is to obtain the confirmation letters from the bank. Yeah. Next challenge could be the one related to those confirmations which have not come at all in case of a bank. See, in case of a bank, generally, except for a very, very small amount, wherein the auditor is also sure that the balance as per the books as well as per the bank will not be of a significant amount, or will not be of a amount which is very small, or the amount which will not be which will be very small. Yeah, only in those cases auditor may skip obtaining the balance confirmations. Otherwise, balance confirmations are required to be obtained by the auditor on 100% basis. Yeah, clear? So this is all about the process of external confirmations. Now, instead of balance confirmations in relation to banks, we may also have a situation of debtors. So I'm now just replacing the banks with debtors. Okay. Now, in relation to debtors, again, the same process is required to be considered by the auditor. Process is all same. Process is no different. And the only thing is, now the statement will not be called as a bank statement, but herein some more points become important and relevant for the purposes of our understanding. Let's try to understand those points. Auditor will send a confirmation letter to the debtors, but unlike in case of a bank, wherein the auditor will send balance confirmation requests to all of them, for debtors it will not be done on 100% basis. Company may have hundreds of debtors. Sending a balance confirmation to a debtor will be done on a sample basis. Now that sample selection is again on the basis of judgment, on the basis of materiality criteria by the auditor, but it's not on 100% basis. Okay, so that means out of the population of debtor, first step will be to select the sample of those debtors to whom confirmations will be rolled out by the auditor. And once the confirmations are rolled out, then the same process will follow. And therein again, some of the challenges which will arise is that some of the debtors don't respond, to whom reminders will go. Some of the debtors may respond to the management, to whom again the reminder will go that please send it to the auditor team or to the audit team directly. Some of the debtors may send the balance confirmations which may not match with the balance which the company would have shown, for which discussions would be done with the management, inquiries would be performed with the management, and the reconciliations would be performed, and those reconciliations would then be tested, verified by the auditor. Herein, another point which becomes relevant and which is generally not acceptable in case of banks is that some of the debtors may not respond at all. And we are talking about this sample. Let's suppose there were 100 debtors, out of which 15 debtors were selected, to whom confirmations were rolled out. So we had 15 debtors over here, to whom confirmations were rolled out. And out of these 15 debtors, still there are 4 debtors who have not responded. Or maybe there are 2 debtors who have not responded. Now, what is the course of action? Can the auditor say that out of this sample which has been selected, majority have responded, so that's why it's good to go without them? The answer is no. Can the auditor say that if only 1 or 2 debtors have not responded, so that's why it will be all right? Again, the answer will be no. See, we cannot do a sample of sample. Means these debtors which have been selected are already on a sample basis. So that's why for this sample, everything is important to be received by the auditor. Means each and every debtor in this list should respond. However, if some debtors out of this sample do not respond, then the audit has to be closed, and in such a case, auditor will have to perform alternative audit procedures. That means in respect of these 4 debtors who do not respond at all, and after waiting for some time, what would the auditor do? Auditor would start performing alternative audit procedures. Alternate audit procedures would be by the auditor. And what are these alternate audit procedures? In terms of alternate audit procedures, auditor would first of all want to verify the collection which would have happened from these debtors subsequent to year end. Means after 31st March, whether there has been any collection from these debtors or not. Next, for all of these 4 debtors, all the sales which have been made to them, which comprise of the balance outstanding to them as at year end, will have to be verified by the auditor. And why is that done? To check the accuracy, to check the existence, to check the provisioning requirements, to check the completeness. That means all the assertions which the auditor planned to verify with this external confirmation procedure will now have to be verified by the auditor with the help of alternate audit procedures. If the auditor is able to do that, then it will be all right. If not, then the auditor will have to have discussions with the management in terms of doing some other alternate procedure or making sure that these debtors respond. Okay, yeah. At times, another challenge may arise and which may have reporting implications. Now let's try to understand what are those challenges. Some of these debtors respond and they respond with the balance which do not match with what is shown in the financial statements and on which reconciliations are not provided by the management. And if the reconciliations are not provided by the management or it is not satisfactory, it is not satisfied with those reconciliations. So what will the auditor require? Auditor will require adjustments to be made in the financial statements because those are in a way misstatements, errors, over which management will have to make the adjustments. Otherwise, this will have reporting implications. Secondly, we understand that all of these communications which the auditor will make with the external parties would first of all require consent of the management. Why? Because these are all parties of the management of the company. Management should not refuse to provide consent to the auditor to make these communications. If the management does that, if the management doesn't allow the auditor to send these external confirmations to the debtors, then the auditor will have to understand the reasons from the management as to why this has not been provided. If there are certain legal reasons around it, which at times are possible, then of course auditor will have to consider alternate audit procedures. But in most of the cases, it will be that management must provide its consent to the auditor to send the confirmations to the external parties. Otherwise, this may also have the reporting implications on the part of the auditor, and particularly where the auditor will not be able to perform alternate audit procedures. Clear? All of you clear on this? Now, let's try to understand what are those areas in the financial statements in respect of which these external confirmations become important, or where these external confirmations are required. To name a few, we have already talked about banks, for which external confirmations are important. Debtors, similarly, for creditors, these are required. For banks, these are required. We have talked about legal attorneys to whom external confirmations are required. And as I told you, it's not about the balance of bank, or it's about the amount which is always required to be confirmed. For example, for legal attorneys, you will not see the amounts going out for them for their confirmation. It's about the cases which are going out for their confirmations. Then it could be about the borrowings of the companies. For borrowings, the confirmations will have to be rolled out, and these are all significantly important. So these are all mandatory. So these cannot be ignored. Similarly, the investments which are made. Yeah. So these all areas in the financial statements will require this procedure of external confirmations on the part of the auditor. Auditor cannot straight away jump on to the procedure which is alternate to this. First of all, auditor will have to perform the external confirmation procedure, because as we have discussed that when it comes to the external procedures, external confirmations, external evidence is always considered to be better than the internal evidence. Yeah, so that's why it's always important that external confirmation is obtained by the auditor. Clear? Yeah. Now let me just go to your queries. Nagasai is asking, that means whether the auditor will send the request letter to the bank in auditor's letterhead. No, it goes on the letter to the management. Sumit is asking, before reaching management, bank reconciliation statement should be checked by the auditor. No, bank reconciliation statement is prepared by the management and then it is checked by the auditor. It's the bank confirmation which will go to the auditor directly from the bank. Anjali is asking, if on 31st of March there are checks issued of various amounts which are material in aggregate but which are subsequently cleared in April and some are not yet clear, should we need to get it reversed, and what if the management refuses for the same? See, it's possible that some of the checks may not have been cleared and some of them may have been cleared, because of which bank reconciliation statements are prepared. Okay, yeah, and if something is happening subsequently, then those will also get accounted for accordingly. If you believe that for some of these reconciling items, transactions should have been recorded by 31st March itself and which have not been done, then of course rectification entry should be passed. Otherwise, you need to look at the materiality involved and of course the reporting implications in line with that. Nagasai is asking, what if the confirmation is not received? What should the auditor do? As I told you, that the next step will be to look at the alternate audit procedures. And if the alternate audit procedures are also not giving the sufficient answer or not the required output, or the output or the response which the auditor has received is different from what the management has recorded in the financial statements, that will have the reporting implications, but that would also require discussions with the management before getting on to any reporting implication. Sumit is asking, sample should be audited 100%. Of course, see, if you have selected a sample, then you need to check it 100%. You cannot say that out of samples, I'll check only few items. Otherwise, what's the purpose of selecting a sample? Clear? Nagasai is asking, if in case of alternate audit evidence is not giving any evidence, okay, so he's saying if the external audit evidence is not good enough, he's asking if the so alternate audit evidence, so he's saying when you perform alternate audit procedures, but the alternate audit procedures which you perform are not giving you the required results. That means the evidence which you wanted to get on the basis of the procedures, first of all, which could not be performed, and now you are getting onto the alternate procedures and those are not giving you the satisfactory response. Then what should the auditor do? Then of course the auditor should reach out to the management, discuss with them that this is a procedure which I want to perform and this is my objective, which is not getting achieved on the basis of alternate procedures. Okay, so the management will have to make sure that auditor is getting onto its objective. If that is not done, then the auditor may have to analyze it from two perspectives. One, this could be about lack of information, and second, this could have implications, of course, related to the modification in the report, but this could be more of in the nature of disclaimer at times if the information provided to the auditor is not good enough, okay, because of which he has not been able to perform his procedures. Yeah, so both these aspects will have to be analyzed when the auditor will be looking at any of these things. Okay. Okay, so now we can pick up one example for this. Say in case of a company, it's about the creditors for whom auditor is performing the procedures, and let's suppose the creditors balances is 30 crores, and out of the creditors, say 50 creditors, say 14 have been selected by the auditor for the purposes of performing procedures, and the auditor plans to send the balance confirmations to these 14 creditors. So balance confirmations were sent, but only 10 responded, and out of 10, balances of 2 didn't match. For remaining 4, alternate procedures were performed. Okay. Now for these 2 for whom the balances didn't match, auditor is of the view that adjustment entries should be passed, because the reconciliations provided by the management are not proper. They have not been able to do this. And for these 4, alternate procedures are performed. Okay, and everything which the auditor wanted to perform has been done. But still, the auditor is going back to the management and requesting, no, I still want these 4 balance confirmations. So auditor has performed alternate procedures and is satisfied with the alternate procedures in terms of the objectives, but still looking for these 4 balance confirmations. Yeah, clear. Now in this case, there are 4 options that we can have a discussion on, and we need to just let me know out of those 4 options or some of these options that I'm able to sort of create now, which one will be the right one. Option number A. Option number A says adjustment entries should be passed. Yeah, these adjustment entries should be passed if these are material and no further action required for 4 balance confirmations. 4 I am saying for these 4. Whenever I am saying 4, so 4 is for these 4. No further action for these 4 balance confirmations. Option number 1. Option number 2. Adjustment entries are a must, irrespective of materiality. Because this was the sample. Adjustment entries are a must, irrespective of the materiality, because of the sample and because of this balance confirmation and because of the reconciliation. There are various reasons. And if balance confirmations are not received, then auditor will have no choice but to report that in his report. Okay, option number B. Option number C. For this part, when the reconciliations didn't match, report reconciliations. Around these reconciliations, around the differences which have been there, auditor should report that. Okay. And around these 4, no action is required. Option number 4. Option number 4 is that no adjustment is required for these two. Why? Because out of 14, 10 have responded, and for 4, auditor has been able to perform the adequate procedures and the reconciliations have also been prepared. It's just that by chance there are reconciling differences which can be resolved later on. Okay, so there is a proper justification available. So that's why no adjustment entries are required. It's illogical to have the adjustment entries in such a situation. How will the management pass an adjustment entry when they are not sure about it? Number 1. Number 2, for these 4, no further action required. Action required. Okay, clear? Yeah. So now out of these 4 options, would you have any option? Tell me. So let's get to the solution. Out of these 4 options, let me just see what's your response. Okay. Should we go to the solution then? Yeah. Which out of these options should be the right one? When we look at the adjustment entries, these have arisen on the basis of balance confirmed by third parties. Correct? And if there are differences, then of course management will have to reconcile that. If the reconciliations are not satisfactory, then what's the course of action? Pass the adjustment entry. And if the adjustment entry is significant, if material, if the differences are significant, only then those are mandatorily required to be passed. Yeah, if not passed, they may have reporting implications. So that's why those are required to be passed if material. Because if those are not material, then it's on the choice of the management whether to pass it or not. It will not really bother the auditor. Smith is saying option number A. As regards these 4, of course, it's understood that the confirmation has not come, but still alternate procedures have been performed satisfactorily. Then what's the need of going in for these balance confirmations once again when the alternate procedures have been performed? Why were the alternate procedures performed? Because the balance confirmations didn't come. And now when the alternate procedures have been performed and still the auditor is asking for this, it's of no point. So that's why this is also all right. So that's why what should be the right option? It appears as if A is the right option. I'm not sure about it. Let's look at option number B, C, and D. Option number B says pass the adjustment entries, which is again correct. These should be passed. But it says if the balance confirmations are not received, then you should report, which is incorrect. Yeah. So that's why we cannot go with option number B. Option number C says that in respect of the reconciliations, because there were some differences, whether you pass the adjustment entry or not, forget that point. Irrespective of that, just because the parties have confirmed the balances which didn't match and the reconciliations arose, that's why you should report it, which is again something not acceptable. Yeah, so that's why this option again will not be possible. This again will not be possible. Moving on to option number D. It says no adjustment entries, which is again not possible. So that's why actually we are left with what? we are left with only option number A, and Nagasai said option number B. I think Nagasai, you are now clear on this. Preeti said, so sometimes company may issue invoice on 31st of March, but it reaches to the other party at a later date, of course, or sometimes may not be received or missed by them. Balances will not match for this year. Can this be ignored if the amount is material? No. These cannot be ignored whether the amount is material or immaterial. This should form part of reconciliation. And that's why it's important to have reconciliations after the balance confirmations, which are showing contradictory balances, or you can say which are showing differences in the balance. And it's very, very common. It's very, very common to have these differences. And some of the reasons which you have mentioned are the reasons why reconciliation statements are prepared. Okay, but you cannot ignore it. You need to have this in the reconciliation statement, and which should then be tested by the auditor. All right, clear on this? Yeah. Any more questions? And I'm hoping that you have understood. Jay is saying, sir, for below material, adjustment also required. See, if this is below materiality, but if you remember, we discussed, even if it's below materiality, adjustment should be made. If not passed, it's okay not to report, but then in such a case, it should go to rep letter. Clear? Clear on this? Okay, with this, we are done with our discussion for today, and we are done with this essay 505 also. So we planned another auditing standard today, but I think we are moving with the good flow, and that's why I will not be picking up that one. And in the next session, we will now planning to continue with the same series. That means this 500 series. So in the next session, we'll continue with the auditing standards, and in the meantime, I would just request you to keep revising all of these things over and over again, please. Yeah, auditing standards are very, very important practically. All right, so thanks to all of you once again for your time, and once again for your wonderful participation. Thanks so much.